Hello and welcome. I'm Tushar Chande. Are you new to technical analysis and don't know anything about candlestick patterns or buying near lows? Then you've come to the right place because this talk will delve into the details of what's called a doji pattern, and I'll show you how my swing system that buys near lows essentially buys near or soon after the doji pattern. So let's get into the details. A quick detour to remind you that trading systems are always designed with the benefit of hindsight, so it pays to be skeptical, and to remind you that past performance is not necessarily indicative of future results. So this is what a typical price bar looks like. First, it summarizes price action over a fixed time period. So it could be 1 minute, 1 hour, 1 day, a week, or a month. It shows the highest and the lowest price. So it shows you the range of price action during that time interval. And it also shows you what the trend of price action, because it shows you the opening price and the closing price. So it shows you the range and the trend of prices over a fixed time interval. Now, the candlestick patterns or the candlestick chart merely converts the information that we already have on a bar chart into another way of representing it that focuses primarily on the body, i.e. the gap or the distance between the open and the close. Clearly, the open could be below the close or the open could be above the close. And for the two events, we can fill the body of the candle with different colors. So for example, we could have a color scheme that says that if the close is greater than the open, then we leave it blank. But if the close is less than the open, then we fill it with, say, a different color like red. So we can communicate information about the position of the close versus the open by changing the color of the candle body. So this shows you how we can convert from a bar chart to a candlestick chart. What happens on the candlestick side is that we focus on the gap between the open and the close. So for this bar, when the close was above the open, we get a large candle that's unfilled. But on this bar, when the close is below the open, we fill the candle with the red color. So it's easier to see a down day, where we are defining a down day as a day on which the open was above the close or the close is below the open. So the theory of candlestick charting says that each candle represents a battle between bulls and bears, and the open to close range shows the relative power of bulls versus bears. So when bulls are very strong, there's a big gap between the close and the open. When there's lack of indecision or lack of conviction, then the open and the close tend to be close to each other. And when the bears have the upper hand, the close will be well below the open. So open to close range shows the relative power of bull versus bears. A single bar or multiple bars form recognizable patterns that occur on all different types of markets and charts and time intervals. And the patterns together represent trader psychology or conviction. So this is a candlestick chart of the S&P 500 index using daily data. If you just look at it, it looks like the prices made a U-shaped pattern. They were at some level on the left-hand side, the prices dropped and they rose again. And if you look at individual bars or groups of bars, you see that we have clusters of red bars when the close was below the open, a cluster of open or white bars when the close was above the open, and then some bars with a very narrow close to open range. So let's look at it a little bit further. So this is the same slide as the previous one using S&P 500 daily data, and you'll see that I highlighted two bars in yellow, and the unique thing about these bars is that the open and the close are very close to each other, and this is called a doji in the Japanese terminology for candlestick charts. In the Japanese language, the word doji stands for blunder or mistake, but in the candlestick terminology, it stands for a bar in which the open and the close are very close to each other. It doesn't matter which one is higher, but they're both really, really close. So it almost appears like we have a horizontal line when the open and the close are plotted next to each other. It represents indecision, hesitation, or equilibrium, and often is a precursor to a reversal. So one of the potential trading strategies after a doji is to buy a breakout after a doji if the prices move higher, and of course you could go short if the prices go lower, but we are buying a breakout after the doji. So let's spend a moment trying to understand all the different ways this pattern could occur. Here I have painted the entire high-low range in a blue rectangle, and I've put yellow double-sided arrows both near the high and the low to show that the high and the low could be much higher or much lower than what I've shown on the chart. And then I've drawn the open and the close in different colors. And again, I put double-sided yellow bars to show you that these bars, that is the open and the close, could occur anywhere along the vertical candle body. They could be here, here, or here, or anywhere else. And also the open and the close don't have to be precisely the same. They could be close together, and it doesn't really matter which one is higher. So that's sort of a schematic overview of what the doji pattern might look like. So let's try to quantify a doji. The basic definition just is that open is approximately equal to the close, which is the same thing as saying the absolute value of the open minus close is approximately 0. But we can rewrite that as the doji is that the absolute value of the open minus close divided by the bar's high-low range is less than 20%. In the limiting case, it would be 0, but practically speaking, we could have a small number here, like say 5% or 10%. And I've just chosen less than 20% as a convenient rule of thumb to help identify or quantify a doji. So the doji pattern is often given different names to show you or hint at where the open and the close are located relative to the high and low of the candle body. If they're in the middle, it's called a doji star. If it's at the bottom, it's called a gravestone doji. If it's near the top, it's called a dragonfly doji. And if it's a very long body, then we call it a long leg doji. So it's all the same pattern. The focus is really on the difference between the open and the close. They should be close to each other, but the location of the open and the close versus the height or the high and low of the candle body allows us to give different names to make it easier to recall the pattern. So let's take a moment to understand the swing system. The rules do not have any reference to the doji pattern, but instead they buy strength after weakness. So the upper panel here has the 7-day stochastic RSI, and we're using data for EQT, which is a energy company. The scale for the stochastic RSI is from 1 to 0, and we have dashed lines at 0.8 and 0.2. So when EQT was weak, the stochastic RSI was below 0.2 and close to 0. Then as the market gained strength, the stochastic RSI rose above 0.8 to 1, and we see weakness here with the downtrend line. EQT bottomed and rallied, and we bought strength after weakness, and this was our day of entry. So the swing system buys near a low, buying strength after weakness, and has no internal information about the doji pattern. So we are back again on the EQT chart, which is the same as the previous slide, but we have shown it now in the candlestick pattern form. This is the entry that we are discussing, and I want to focus on the few bars that occurred going into the day of entry. So let's identify the doji pattern, and you see that I have used a highlighter to identify the doji pattern that has occurred several times on this chart. So the first information point is that dojis are very common, and they occur anywhere on the price chart. They don't have to occur near a bottom or a top. They could occur near a top or near a bottom, but they don't have to. So the doji is a very common pattern, occurs all over the place, and we want to focus on the few bars leading into the entry of the swing system. So if you look at the 1, 2, 3, 4, 5, and 6 bars together before the day of entry, essentially we find that these bars together form a doji, because here's the entry point into the cluster, here's the open, here's the close. So the open and the close are very close to each other, and here's the high-low range. So this is like a long-legged doji, and so essentially, effectively, we have a distributed doji, if you're a fan of cooking, and we are buying a breakout after the doji. So we have consolidation shown by the doji, and we are buying a breakout from that consolidation. So we are continuing our look at the EQT chart. This is the main trade we are focusing on. The 6 bars before, 1, 2, 3, 4, 5, 6, formed a doji, and you see that there's an entry here which has a 4-bar doji effectively before it, and another entry here which had a 3-bar doji before it. So essentially the doji pattern doesn't have to occur as a single bar, but could be broken up or distributed over, say, 2 or 6 bars or many bars, and essentially represents sort of a consolidation or indecision on the market that occurs over several days, and we are buying a breakout beyond the consolidation or beyond the distributed doji. Now I want to show you that this pattern doesn't occur uniquely only in EQT. This is an example of Enphase, which is a company that does work in the EV area, and here again we have a entry from the swing system, and if you look at the 1, 2, 3, 4, 5 bars here that occurred a little before the day of entry, we have another distributed long leg doji, which is sort of the same phenomena we saw on the EQT chart. This is the Enphase chart, but we have expanded the window a little bit. Now we're looking at 1, 2, 3, 4, 5, 6, the 6 bars before the day of entry with the swing system. And again, in effect, we have a distributed doji. So the point I'm making here is that the buy strength after weakness logic that's embedded in the swing system helps you buy near a low, but coincidentally or uniquely, we are also seeing that there's often a distributed doji pattern just a little bit before the entry of the swing system, because the swing system is capturing this market indecision near a potential low in the market. This is another example using corn futures, a commodity, and this is the day of entry using the swing system. And if you looked at the previous 6 bars, we again get a 6-bar distributed doji, because here's the open, here's the close, here's the high, here's the low. So this cluster of 6 bars is effectively acting like a doji, and we are buying a breakout after the doji. And of course, if you wanted to be strictly careful, you'd buy somewhere over here, which would be the breakout beyond this doji. But the system, of course, doesn't know anything about doji, so it's buying here instead of, say, over there. But the point I'm making is still valid, that the doji pattern represents sort of a consolidation or indecision, and the swing system, which buys strength after weakness, often seems to be buying around a doji pattern. So this is a chart for Tesla, where we are showing the swing system that entered in late August after a small consolidation, and then the system followed what turned out to be a mega trend and got out a few days after the absolute high of the move. But again, at this point, of course, we have no idea how far the trend is going to go, but we are going to focus on the few days before the entry into the swing system. And just for reference, the upper panel has the Chande trend meter on a scale of 0 to 100. And you see that after the entry, during this entry we had weakness, and we bought strength after weakness, and then the market followed through, and the CTM rose above 90. So in many ways, this is the ideal signature for a successful trade with the swing system. But we're going to go back and look at the few days before the swing system entry on the next slide. So this is the same Tesla swing system entry as the previous slide. That's over here. And I want to focus on the 6 bars before this entry. And essentially we have a 6-bar distributed doji. Here's the open, here's the close, here's the high, and that's the low. So we essentially have a long-legged doji occurring in the 6 days before the Tesla entry. So again, the swing system doesn't know anything about the doji pattern, but in practice, it appears many times that we have a distributed doji pattern that's occurring over multiple bars of daily data before the point of entry. So this is just to show you that the doji pattern or the doji idea is encapsulating an idea of consolidation, and often if that occurs towards the low of a move, then we can get entry on a breakout from the doji. This is a chart for QQQ, and this is just to remind you that the swing system is designed to buy near lows, and I've highlighted in the circles some of the points of entry that we would have liked to have with the system, and sure enough, the swing system has successfully entered after these major lows. So the swing system essentially allows you to buy near market or stock lows. So let's summarize what I've discussed so far. The swing system captures the doji logic and spirit. The dojis are often distributed, that is, they're not always a single candle, but could occur over, say, 3 to 6 or 7 candles. But the swing system does not actually include an explicit filter for doji. It just shows you that though we have completely different concepts, the doji and the swing system, in effect, they're working together because they're capturing some form of market psychology. And just to show you the bigger picture, I have a package for Metastock called Tushar Chande's Complete Toolbox, and it has a tool for answering the question, is the market trending, using the Chande trend meter. It has a long-term system that buys strength and has a volatility exit, and it has two counter trend systems, the volatility system and the swing system, which buy weakness and use a delayed channel exit. And we've been talking about the swing system, which is sort of a counter trend entry and a trend following exit. So thank you for staying through the entire slide deck. I hope you will spend some time to check out the Tushar Chande's Complete Toolkit. It's very easy to learn, it's simple to use, but it's very powerful. It's very clear and unambiguous. You can use it on any time frame, and also you can use it on any exchange or instrument. And you can get it at metastock.com/Chande. Thank you again, and have a great day.